Well, you can assess the demand in different ways. But if I were to sum up the move, I would say the demand remained sustained. So there is still a strong demand for mortgages, albeit at a slightly lower rate than in the past. So if you look at numbers, for example, in the balance sheet of the banks, broadly speaking, year on year, you still have a significant growth in the balance sheet of the banks. The exposure has still grown by, let's say, 30% in Q2 2022. But at the same time, and when you look at the data, sorry, I'm confused there. The number I gave you is on the market, so the data provided by SAMA. When you look at it, Q2, you have a 30% growth. When you look at the previous quarter, it was higher. But this element shows that the demand is still sustained, even though it's at a slightly lower pace than in the past. So 30% growth for a quarter year on year is pretty big. Nevertheless, it slows down. It has slowed down a bit compared to where we were in Q1 or where we were at the end of 2021. So strong demand, which is visible in the balance sheet of the banks and in the data provided by SAMA. Well, at the moment, if I look at the refinancing, it's a very small market still at the moment. The key player, by refinancing, let's say it's everything that would cover reselling, refinancing of loans. The main proponent of the refinancing market is SRC. So I don't pretend that we cover 100% of the refinancing, because some originators may sell to other originators. For example, mortgage finance company may sell to banks. But I tend to think that those transactions are relatively limited in numbers and amount. The big number comes from SRC. So around Q2, we were at 18 billion SAR deployment in Q2, and we are keeping growing our balance sheet. It's the mortgage market has experienced a remarkable growth over the past 5 years. If you look at, and I'm just looking at the banks and the mortgage finance company, I leave aside the legacy portfolio of REDF. So when you look at the market today, we are probably around 640 billion SAR, which doesn't tell much, but when you think about it, we were at a bit more than 200 billion outstanding in 2017. So in almost, let's say, 5 years, the mortgage market has tripled in the kingdom. And the number of contracts themselves, if you measure by number of contracts rather than by volumes, it moves from 120,000 mortgages outstanding in 2017, and today we are above 500,000. So it has been multiplied by almost 4. So very dynamic market, growing market, still growing, as we said before, but at a slightly lower pace. So first, let me address your question on the rationale. Why do we issue sukuks? SRC has a very simple business model. Our purpose is to be an enabler for the mortgage market, supporting the primary market. So all the banks, all the mortgage finance company, everybody originating mortgages, by creating the possibility to refinance, get access to liquidity for those loans. So we are the pillar of the secondary market and supporting the primary market. What does it mean? That means that we need to make sure that we can provide liquidity to primary originators. I don't collect deposits, We don't have a legacy activity. The company was created in 2017. So what does it mean? That means that we are an enabler for the primary market, mortgage market. We are a provider of liquidity, and we are a bridge between the primary market and capital market. Therefore, in order to provide liquidity, I have to issue sukuks in the market. That's the way I can myself get access to liquidity and provide this liquidity to banks and mortgage finance companies so that they can keep providing mortgages to Saudi citizens. So when you look at that, what does it mean? That means that practically we have to issue sukuks. We started doing it in the domestic market first because it's our home market. It's a market which is knowledgeable, that understands and knows the mortgage product in the kingdom. So we have already issued 11 billion in this market. We have recently obtained, with the support of our stakeholders, the green light of the regulators to extend the size, increase the size of our domestic program. And we are at the moment in the market to issue, as you pointed out, additional sukuks on the domestic market. So, and the reason why is, as I said just before, it's because we have more and more assets to refinance. So we are providing liquidity to the banks and the mortgage finance company and trying to fulfill our mission. There is another element, is by also providing issuing sukuks, we are trying to contribute to develop capital market in the kingdom. The market is very well developed in terms of access to equity. I think that we still have, and we worked a lot, and we are not the only one, but we worked a lot in conjunction with MOF, with CMA, with TADA. We're trying to expand the market, make the market more attractive. So it's important for the local investors so that they find papers and they find sukuks they can invest on. But it has also for us, and I will come to your second question, it has also an educative or teaching credential building process vis-a-vis the foreign investors that we expect to attract to the Saudi market. So at the moment, yes, we are focusing on the domestic market, but we are clearly intending to tap the international market. So we are at the moment working on our program for international issuances. We expect, it has been a long work. We have a couple of topics we need to close before we are ready for inaugural issuance. We expect this inaugural issuance to take place somewhere in 2023. And then we will go, and whilst we keep the domestic market open and we will keep issuing, we will at the same time raise liquidity from international market. So that's one of our key objectives. So actually, what we purchased from, we have three categories of customers at the moment. We have banks, we have mortgage finance company, and we have what I would call non-regular, non-traditional financial or non-financial institutions, such as PPA Gozi and such as REDF. At the moment, our portfolio is, I would say, 2/3 skewed towards non-regular or non-financial institutions, and between 1/3 and a half of the portfolio towards banks and mortgage finance company. We think that it's a temporary. If you were asking me the question, let's say 3 or 4 years ago, I would tell you that 100% of our portfolio is made of loans or refinancing with the mortgage finance company. And then it has started to rebalance with banks participating. Then we have added non-financial institutions to the partners we have in this process of providing liquidity for mortgages. I think that going forward, the things will rebalance again. We have a very strong pipeline. We have a lot of discussions with financial institutions at the moment. The environment, the interest rate rise is a bit less simple to handle and the situation has changed compared to the past. Therefore, we expect that the banks will become a growing player and a growing portion of our portfolio going forward. We expect to be somewhere between 22 and 24 billion by the end of this year, which is a relatively significant increase compared to the end of 2021, which itself was a big increase compared to 2020. We have almost a geometric, it's not perfect, but we have almost a geometric progression. We are doubling the size of our balance sheet. I'm exaggerating a bit for 2022, but that was the case for 2021. We won't keep growing necessarily at the same rate, but we are expanding and deploying our balance sheet. So which means that today, if you look at it, and by year end, certainly, SRC will be among the biggest, not the biggest, but among the top owners or holders of mortgage or mortgage-related exposures in the kingdom. So far above the mortgage finance company, below the big Saudi banks, but somewhere close to the big Saudi banks as it goes. And it's not the size for the sake of it. It doesn't matter. What matters is that if we grow, it's because we hope and we think we are providing something to the market and we are providing the support the originators need. So we are not proud of the numbers just because they are numbers. It's just that it shows that SRC is progressively playing its role and bringing its contribution to the housing program. So it's a very interesting question because that's not the first time that we are collectively experiencing, and I mean since SRC has started and since we are engaged with the banks. When we started in 2017, the rates were on the ramp-up process and they were increasing until we reached 2019, and then they decreased significantly. The big difference compared to a few years ago is the rhythm at which the interest rates are increasing. They increased by a big leap, so there are still some questions around how many of them, how big they will be, given the fear of recession. But there is the stretch is there, and they are increasing quite significantly every time. So it changes in a context which is more challenging. It changes a bit the environment. What is the impact for us? When I look at the company itself, it has a very limited impact. And the reason is the following. Since our creation, we have been a big proponent, a big advocate for long-term fixed rate mortgages. We think that it's the best product in my mind to give to borrowers certainty in terms of repayment, visibility. And it's important because we shouldn't forget that buying a home is, for most of us, the biggest investment we will ever do. And having an investment which you are paying over time, but that could increase significantly, or worse than that, you can put your, let's say, your comfort, the quality of life of your family at stake because all of a sudden you can't afford anymore your mortgage, it's a big problem. So since the beginning, we have been a big advocate of a long-term fixed rate. We have been followed by the banks, we have been followed or supported by our stakeholders, and we shared these objectives with our friends of REDF and other entities in the housing ecosystem and program. So we push that. Now, when you have long-term fixed rate assets, one of the priority we put at the top of our refinancing process was to match fund our assets. So therefore, I have long-term fixed rate assets that are funded mostly, and we work on a modified duration neutral process. We have long-term liabilities we are issuing on a fixed rate basis as well. So if the rates are increasing tomorrow, it doesn't jeopardize my refinancing. It doesn't jeopardize or create a gap between my refinancing cost and my assets. My assets, for my legacy, I'm covered. If I stop buying portfolios, if we do nothing more going forward, I can let the portfolio amortize. I will repay my sukuk over time, and the move of the interest rates will have zero impact. I'm talking about from a cash flow perspective. If you talk about market value evaluation, that's a different story. So that's one thing. Now, we are not totally insensitive to the interest rates increase for two reasons. The first one is that today I'm about to buy a portfolio. I have to anticipate the conditions under which this portfolio will be refinanced in the coming month. So when the rates are decreasing, it's a bet that is easy to take because you buy loans at 5% margin, and then you refinance them at 3, 2, 1, or 0. Great. When the rates are increasing, obviously it's a bit more challenging. So the first element is we are very careful about the way and the process whereby we design the pricing of the loans, the liquidity we are providing, because we have to anticipate over a couple of months the interest rates increase. So the good thing is it's a limited risk we are talking about in terms of amount, in terms of horizon, but it's a risk we have to live with and we have to tackle. The second element, which is more macroeconomic, and it's not, if you want, necessarily triggering difficulties for the company or for the banks themselves, is if the interest rates are increasing, you can expect that mortgages are becoming more expensive and therefore, and less affordable. Therefore, you will have less people capable of taking a mortgage or being eligible to a mortgage. So the problem we are facing, or the impact of the interest rates rise, is the cooling off of the mortgage market because mortgages are becoming more expensive. It could be good if you are in an economy where there is a lot of overheat around house pricing, people overstretching themselves to get mortgages, etc. The purpose of increasing the rate is to cool off the demand, and then it does make sense. If we are in a context where the growth of the price house is much more reasonable, the mortgage demand is much more controlled, because of the regulation, things are more, let's say, reasonable and sensible. Of course, the increase of the rates may add an element of cool off of the market, but then it will be an element, it could slow down the growth, but it won't necessarily kill it off. We will see how it evolves. So there is an element of forecast, there is an element of macroeconomic consideration when you look at the impact of the interest rates on the evolution of the mortgage market.